Well, the Fed has come and gone, and the markets seemed to like what they heard, if you ask stock markets. But one of the places where we definitely saw some consternation was in bonds and most especially in currencies. That's what we're going to focus on here. First, we're going to, of course, take a look at what the Fed did, what it meant for markets, and why did stocks and bonds and currencies react the way they did. But then we're going to take a look at one market that perhaps has more of this to do as more event risk comes into the picture. We have the Bank of England monetary policy announcement that's in view, and the main story there is very much about the US dollar, interestingly enough, as we break down the trading opportunity that might be on the menu. So let's begin here first and foremost with what the Fed did and how that registered for markets. This is the S&P 500 here, of course, a kind of barometer for overall market sentiment. And we can see here, I think, with fairly clear relief exactly what the markets thought of the Fed's messaging. This is an intraday chart. Each bar is 15 minutes, and you can see where the Fed occurs right here. 11 a.m. Pacific time for me in San Francisco is the mark on this. And there you are. The markets liked what they heard. Now, why did they? Well, what you see in bonds tells you the story. Bonds soar as you get this policy announcement, ostensibly because the Fed had given the markets what they wanted, which is to say, the Fed sounded supportive enough for the markets to reckon that their concerns about a slowdown in the economy, some sort of a risk building toward recession, that the Fed is mindful of this, and that the Fed will react accordingly. The story looks very similar in gold, of course, a kind of natural foil for fiat currency and a natural foil for interest rates. Gold, of course, yields nothing. And so as you get this rise in bonds and the inverse move in yields, a fall in yields, not surprisingly, gold gets another nudge upward. Now, as we look at all of this, it is, of course, helpful to gain a sense of context. Here is that context. Now, we can see from late February, a string of economic data begins to tell the markets that there is some kind of a serious issue that is occurring vis-a-vis the U.S. economy. Now, of course, this is a situation here where you're looking at what is essentially a nowcast in the sense that it just takes in economic data as it comes in. And so what's occurring here is essentially less so about the level. I wouldn't necessarily think that it is inherently a plausible thing to think that the U.S. economy is going to shrink somewhere around 2% year on year in the first quarter. But this is hardly the important part of the story. It's the tone of the data that would have this running tally of GDP expectation move so sharply lower. And so clearly the tone has been eminently negative. And with that in mind, you have seemingly a situation here where there is a serious kind of consideration. What is anybody going to do surely this is being seen, and surely that this has caused consternation in the markets since late February, obviously with sinking readings on S&P, on NASDAQ, all Russell, all around. Surely somebody will pay attention and do something. And of course, the message from the administration has been, well, this is fine. We're not concerned. This is an adjustment that will run its course, and then everything will be okay. But of course, what we also see is that in the market's consternation, they are not amenable to that explanation. They wanted somebody to say something that would be supportive. And what the hope was that the Fed would do that. And by all accounts, the markets seem to be accepting that the Fed delivered. Here's the summary of economic projections here for the latest update. Now, what's critical here is there's no change in the pathway for interest rates. We're still looking to get to 3.9%, which would amount to a 50 basis point cut for this year. We're still looking at the same thing for next year, another 50 basis point cut, and then a quarter point cut for 2027. Where we do get some very significant changes in the way that this looks is, of course, in expectations for GDP. They're revised sharply lower for this year and next year. Unemployment revised higher for this year, but steady. Inflation, though, meaningfully higher for this year and next, both at the headline and at the core. The other sort of interesting thing that has emerged here is that the range of outcomes has really moved around. So, for example, for core PCE, the central tendency was 2.5 to 2.7. It has moved to 2.7 to 3. Note that not only did we shift up, but the amount of variation, even in the central tendency, has increased. Notice something similar for GDP. Again, we move to a lower setting, but also the level of variance is changing and showing us that there is greater uncertainty around these expectations, which of course is exactly what we hear in the policy statement. They say that the outlook has become more uncertain. It's exactly what we hear in the press conference with Chair Powell after the meeting, where we hear that things are more uncertain. And so it seems like what the Fed has done is it's basically told the markets that it is seeing their consternation and it is prepared to act if action is warranted, but that it isn't going to act just right now. That the Fed feels like it still has time before it pulls the trigger to really step out and take some sort of policy change. But at the very least, the markets feel like the Fed has acknowledged the concern and is mindful of it and would come to the rescue if needed. That seems to have been enough. Now, we'll see, of course, how long this optimism holds for stocks, but the one place where it looks very clearly to have registered as dovish is, of course, in the bonds, and against that backdrop in the dollar. The dollar down pretty much across the board today, and the next big piece of event risk speaks to the possibility that we could continue to head in that direction. And that, of course, is coming at us from the Bank of England. The expectation when they meet tonight is going to be that they hold policy unchanged, but of course, the story, much as it is and as it was with the Fed and with the ECB before, is what's the guidance going to look like? And what we see here now is, here's the current rate. We can see that we don't see the first cut here until June, and then we see a second one sometime by basically September, November, when it starts to look like the cut is in. And of course, by the end of the year, that second cut is fully discounted. If we look at the overall tally, it looks like we're looking at those two cuts then for this year, nothing for next year. And really what the market is going to want to hear is to what extent this still makes sense. When we looked at what was going on with the ECB going into their meeting, there was a serious question as to what the ECB would say about the building consensus between London, Paris, and Berlin about the need to rearm, about the need perhaps to build European defenses in a hurry, because the faith in the U.S. security blanket that Europe has relied on basically since the end of World War II has become eroded by some of the recent actions, in particular around the war in Ukraine and U.S.-Ukraine relations. So what we saw heading into that ECB meeting was this idea that, okay, if the region has to rearm in a hurry, that's a bunch of fiscal spending. It is also a big inflationary impetus then, and as a consequence, a reason why rates may not come down as fast. And although the ECB cut rates, the outlook for this year shifted to a less dovish setting, and more importantly, the outlook for next year went from envisioning perhaps no change to now about a 50-50 shot at a rate hike. And that's really the story as we get into this BOE announcement again. We, of course, have already seen a surge in the euro around the idea that this all is coming to take European bond yields higher. And at a time when the markets are thinking the Fed may be a little bit more biased in a dovish direction, that's, of course, shifted yield spreads against the euro, or against the dollar, and in favor of the euro in relative terms. And of course, the euro has absolutely soared. The trade here for the pound, which hasn't had that same kind of an adjustment to the same extent, and which is now facing a similar monetary policy announcement, is will we get another big nudge now for this currency against the U.S. dollar? And so the markets are going to be watching very closely what the Bank of England says about this build out, and maybe the possibility that after this year's easing, which is already fully discounted and not really a hurdle for the pound because it's in the price, whether we're going to see expectations for a more inflationary environment next year around this defense spending start to shift the math for next year maybe into a positive direction, or at least flirting with the possibility of hiking rates as we are with the ECB. And indeed, the economic data seems generally supportive. We look at UK inflation. It is marching higher. The headline number most recently here back to 3%, core back to 3.7%. Core has not had the kind of vigorous upswing that the headline numbers have, but of course, it is not any less troubling that it has stopped falling toward the BOE's target. So it isn't in much of a position to be cutting. Moreover, if we look at the breakdown in these inflation statistics, it is again something of a concern that most of the sticky inflation here is in what you might expect to be areas of prices that are much more amenable to go the other way. So there's been a come down on the fuels side of things. That's encouraging. The food side of things is not a big influence, but it certainly has started to look a bit spicier. But it's really this right here, which has been a persistent thorn in the BOE's side, this almost full percentage point of contribution to overall inflation, which if you could shave down, you'd be essentially at target. And the part of this that really kind of bedevils officials is recreation, restaurants, and hotels, so hospitality, that really should be responsive to diminished discretionary spending as the economy slows, as indeed it has. If we look at the PMIs here, what we find is that the story is of standstill. The composite index here has basically diminished since the beginning of last year and slowly ground to essentially a halt. These PMI numbers, of course, as ever, centered around 50, where that's neutral. Above 50 is growth. Below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And so we're at 50.5 here. We're basically not doing either. The economy is essentially standing still, and that has come thanks to the diminishing service sector. Meanwhile, manufacturing is very much still in an anemic contraction state. So the story here, you would think, would be of meaningful economic weakness that works these discretionary spending categories down and gives the BOE more room to cut. But that has not occurred, perhaps because the labor market implications of having hired for the staffing of these sectors amid the initial COVID reopening has basically locked in their wages at high levels, and we've not seen that unwind. So with that in mind, we have seemingly all the ammunition that the BOE needs in order to hold pat this time. It'll be interesting to watch what the voting pattern is going to be on the 9-member MPC committee that sets policy, but for now, it looks like there's no reason to do much of anything. And what this speaks to is this very close relationship between the British pound and U.S. yields. In the candles here is the pound's exchange rate against the U.S. dollar. The magenta-ish line here is the U.S. 10-year yield looked at inversely. So this right here would be U.S. yields rising, and the dollar then rising against the pound with those yields. This is yields falling, and this is the dollar falling against the pound as we see in tandem. So this is less seemingly a story about what the BOE is going to do and more about we have a Fed that's seen as more dovish by the markets, and the more that continues to be the case, the more the pound is rallying, and all the BOE really has to do is not get in the way. And if anything, their bias is to at least rhetorically nod at maybe some inflationary risk next year, maybe not. So as we look at what the pound here is doing, it's testing this critical area right around the 130 figure. If we can punch through that as the BOE announcement comes out and takes event risk out of the picture, there is a wide gap that opens up here all the way toward the 133 figure north of 132.50. And so what we potentially have is a trade setup with some legs. Now, if the BOE is soggy and there is a pullback here, then the bottom seems relatively close up, just above the 128 figure. If there's a pullback through that, then right around the figure, there may be better support from which to entertain the long side. But as it stands, the trend is firmly higher. And what the BOE may give us here is another bite at the apple to participate. And that is Macro Money for today. As ever, we are here right after Overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go from there. We are also on with Chris for Futures Power Hour Mondays and Fridays. Definitely tune in just 30 minutes time from now as I join Victor Jones for The Price of Truth. Victor and I will be back with Tom for First Call on Sundays. I'm writing for the News and Insights portion of tastylive.com. and opining at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. Thanks very much for joining. Like and subscribe if you're watching on YouTube. Macro Money's back tomorrow.